Assalamualaikum and good morning. In today's lecture, we're going to cover loss aversion bias. Okay, as mentioned by Ralph Waldo Emerson, win as if you were used to it and lose as if you enjoy it for a change. Yeah. In this lecture, by the end of the lecture, all students should be able to explain the general and technical description of loss aversion bias, understand the practical implication of loss aversion on investors, and lastly, to propose a suitable advice for various loss aversion bias. Coming into the general description of loss aversion bias, it was first developed by Daniel Kahneman and Stavsky in 1979 as part of the original prospect theory that which we have covered in our first two lectures. Yeah, psychologically, the possibility of loss is on average twice as powerful as a motivator as the possibility of making a gain of equal magnitude. That is, a loss-adverse person might demand at minimum a $2 gain for every $1 placed at risk. In this scenario, risks that don't pay double are unacceptable. So, in other words, that everyone that is putting a dollar at risk would want to demand a return of $2 that is twice as much as you put out for at risk. So get even it is a diagnosis to describe the widespread affliction whereby a person waits too long for an investment to rebound following a loss. Thinking that it will recover, thinking that a lost position will rebound to make more profit. Investors tends to wait too long until it's too late to make a decision. Get even it is can be dangerous because the best response to a loss is to sell off the offending security and to redeploy those assets. Looking into the trend when it is start losing out, when the trend is coming down or decreasing, you should be able to make fast decision, that is to sell off your losing security, losing stocks, and to rearrange or to reinvest it at some other stocks in different industry or perhaps in a different sector. However, many investors do not do that. What they do, they were thinking about get even it is, meaning to say hoping that the price will rebound and gaining a profit. Loss aversion bias can make investors dwell excessively on risk avoidance when evaluating possible gains, since dodging a loss is a more urgent concern than seeking a profit. Meaning to say, waiting too long for the rebound to happen and try to avoid risk and try to, dodging a loss means you wait that until the loss is recovered rather than lose now and make money later. Lose now, sell off it, and make more money in some other sectors. So that's loss aversion risk, yeah, or bias. The technical description of loss aversion bias is comes from prospect theory, wherein Kahneman and Stavsky discuss loss aversion in the context of S-shape. We have looked into this graph in many biases before. Yeah, all right. This represent utility. The utility represent value function that models the entire evaluation stage in the prospect theory. According to Kahneman and Stavsky, people weight all potential gains and losses in relation to some benchmark reference point. Remember, we're looking into some reference point in the middle. The value function that passes through this point is asymmetric. That is, its profile implies, given the same variation in absolute value, the bigger impact of losses than of gains. Looking into the graph of the S-curve, you can see that the curve itself in gains is much smaller, and the value that people perceive in losses is twice as much as the gain. The result is that risk-seeking behavior prevails in the domain of losses that is below the x-axis, while risk-adverse behavior prevails in the domain of gain that is above the x-axis. The deposition effect, as indicated by Hirschfeld and Mark Steinman, is that the desire to hold losing investment too long, that is risk-seeking behavior, and to sell winning investment too quickly, that is risk avoidant behavior. This effect actually a sum of loss aversions bias, because you holding on to a losing investment, looking for more risk, and also selling investment too quickly in order to avoid risk. Okay, that contributes to loss aversion bias. So the practical implication of loss aversion bias is that investors open up the monthly statements prepared by their advisor, skim column of numbers, and usually notice both winners and losers. In classic cases of loss aversion, clients dread selling the security that has not performed well. Get even it is takes hold when clients are doing that. The instinct to hold into a losing investment until, at the very least, it rebounds enough for a client to break even. So this is what the classic cases of loss aversion. People are holding on to the losing security. They are dragging themselves. They do not want to sell the security because of the get even it is diagnosis. So however, research into a losing investment would reveal a company whose prospect doesn't or do not forecast a rebound. Yeah, it reveals that an empirical research or time series analysis have revealed that losing investment would not rebound. Continuing to hold stocks into that particular company actually add more risk to an investor's portfolio. Conversely, when the monthly statements indicate that profits are being made, a loss-adverse client is gripped by the powerful urge to take the money and run, rather than to assume continued risk. This is risk avoidance takes place. Yeah? Therefore, selling deteriorates that risk-return profile and eliminates the potential for future gains. Some investors, remarking on losing investment that has not yet been sold, realize that it is only a paper loss. Okay, of course, in one sense, yes, it's true, it's only a paper loss because the price goes down, you have not selling it yet, so it's just a paper loss. However, if you went to a market to sell, having just incurred a paper loss, the price you would obtain for your investment would be lower than the price you paid, affecting a very real loss indeed when you actually sell it. Thus, if holding on a losing investment does not objectively enhance the likelihood of recouping a loss, then it is better to simply realize the loss, which won't remain on the paper forever. Meaning to say, you realize it quickly, you lose now, and it would not continue losing on paper forever. Yeah. So implication to investors. Firstly, loss aversion causes investors to hold losing investment too long. This behavior sometimes described as in the context of debilitating disease, that is, get even it is. This is an affliction in which investors hold losing investment in the hope that they get back what they lost. This behavior has seriously negative consequences by depressing portfolio return, meaning you're slimming down your portfolio returns as a whole. Secondly, loss aversion causes investors to sell winners too early, in the fear that their profit will evaporate unless they sell. So this behavior limits upside potential of a portfolio that can lead to too much trading, which has been shown to lower investment returns. So meaning to say, there is a potential for the price to go even higher, but you are being risk adverse and you try to sell it before you are trying to avoid risk. You try to sell it off without thinking of the potential upside of the stocks. Third, loss aversion can cause investors to unknowingly take on more risk in their portfolio than they would if they simply eliminated the investment and moved into a better one or stayed in cash. So rather than rather than cut off the losses or minimize the losses, they would unknowingly take more risk by holding to the lost investment. Alright, and fourth, loss aversion can cause investors to hold unbalanced portfolio. If, for example, several position falls in value and the investors is unwillingly to sell due to the loss aversion, an imbalance can occur. Without proper rebalancing, the allocation is not suited for long-term goals of the client, leading to suboptimal return. So this is a diagnostic test for you to do. To be sure, answer truthfully. Okay, suppose you make a plan to invest 50,000. You are presented with two alternatives. Which scenario will you have? A, be sure that I get back my 50,000 at the very least, even if I don't make any more money. B, have a 50% chance of getting 70,000 and a 50% of chance of getting 35,000. So you have a 25% chance, 50% chance of getting 70,000 and 50% chance of getting 35,000. So you are gaining 20,000 and you are also losing a bit of 15,000. So which one do you choose, A or B? So most people, however, would probably select B because most people tend to be loss adverse. Loss adverse investors are willing to gamble and risk an even greater loss rather than to admit a loss. That is in A. However, this isn't simply a matter of unconditional panic for gambling. Most investors, that is loss adverse investors, prefer to assure of breaking even over opportunity to gain a profit. Okay, they just want to break even. Okay, question 2. Suppose you make a plan to invest 70,000. You are presented with two alternatives. Which scenario would you rather have? A, know that I only be repaid 60,000 for sure. You know that you will only get 60,000 for sure. Take a gamble of 50-50, knowing that I'll get back either 75 or 50. So which one do you take, A or B? Okay, let's see if you all take A, what happened? Who are you? What category do you fall? If you B, is what category? People who are loss adverse are most likely to select A, even though B offers a larger potential return on the upside. Okay? So 3, choose of these two outcomes. An assured gain of 475, B, a 25% chance of gaining 2,000 and 75% chance of gaining nothing. This is a gamble. One is sure of getting 475. Yeah? One is chance of getting a higher profit or nothing. So a rational response is B, but loss adverse investors are likely to opt for an assurance of a profit in A. Okay. Question 4. Choose one of these two outcomes. Assured loss of 7 to 5. B, a 75% chance of losing 1,000, which is more, and a 25% chance of losing nothing, that is 0. An assured loss or even more loss, but and also 25% chance of nothing, losing nothing. A rational response is A, which is 475. That is very smaller than 2,000. Loss adverse investors are more likely to select B because there are element of gambling there. Alright, as an advice, okay, we will continue the advice in the next video.